Charan sir, start please.
As chairman of the Banking Council of ASSOCHAM, I welcome everybody for the shadow monetary policy, which ASSOCHAM and AGRO does it together. And we are going to have the monetary policy on April 7. So we have scheduled the shadow monetary policy on April 3 today. The objective of this exercise is providing inputs for the main monetary policy committee. And in the main monetary policy committee, we find that there is the governor and other members. And here in IGRO shadow monetary policy, we associate the industry. So we get industrial inputs also, which we provide then to the governor and the RBI. With this, the chairman of the session is Dr. Arvind Virmani, who is also the chairman of IGRO Foundation. I hand it over to him. And as per the program, the welcome is being given by Subhash Agrawal. The chairman will conduct the proceedings further on. Dr. Virmani, please.
Well, I usually take over after the introduction, but yes, please, Mr. Agarwal, I guess, is the.
Yeah, thank you. Good afternoon, everyone. I am happy that I am giving this job of welcoming address and opening remarks. So I am pleased and very happy to welcome Dr. Arvind Virmani, former Chief Economic Advisor, Government of India. He is the chairman of the session. And we have Sri Rishi Gupta, co-chair, ASSOCHAM National Council for Banking, and MD and CEO of Fino Payment Bank. We also welcome you, sir.
Thank you.
We have other panelists, Sri Indranil Sen Gupta, Chief Economist, Bank of America Merrill Lynch. We will also extend our welcome to you, sir. Our another panelist, Ms. Upasana Bhardwaj, Senior Economist and Senior VP, Kotak Mahindra Bank. We also extend welcoming you. Again, Mr. Abhik Barua, Chief Economics and Executive Vice President, HDFC Bank. We also extend and welcome you, Sri Abhik Barua. Sri Sibasis Misra, Director, Acceptance Re-Innovation Technology. We also welcome you, sir, and our Dr. Charan Singh, who is the instrumental and conducting this seminar and always very happy person. So we also welcome Dr. Charan Singh, Chairman of ASSOCHAM National Council for Banking, and also we welcome to all the audience sitting in this seminar. So first of all, I would like to congratulate ASSOCHAM and IGRO Foundation, Dr. Charan Singh, Arvind Virmani ji, for conducting this seminar and providing input on behalf of ASSOCHAM and IGRO Foundation to RBI before their monetary policy committee meeting. So as we know that monetary policy committee meeting is going to happen the next week, and RBI governor will speak on 7th April, Wednesday, declaring RBI monetary policy decision. So what RBI is thinking, I think RBI is trying to keep interest rate low to support the economic policy and also facilitate government huge borrowing plan in the year 21-22. 6-member MPC is expected to keep the repo rate unchanged at 4% while continuing the accommodative stance. RBI governor will announce the monetary policy next week on Wednesday. As we know, they have decided their dates earlier. They have decided all the dates for their bi-monthly 6th meeting, which is going to be held in 21-22. So for containing this repo rate unchanged and facilitating accommodative instant policy, there are certain challenges. First challenge is rising inflation numbers. we have seen last year inflationary pressure returned in the economy. Supply chain issue after post-COVID created spike in inflation. Surplus liquidity in the system in also contributing high inflation. Retail inflation or CPI was 5.03% in February, which is more than the RBI mandated 4% with a tolerance of 2 to 6%. The government has also decided to continue with 4% inflation target for next 5 years. In fact, government has decided and extend for this same 4% up to 2% plus minus. The WPI has also doubled from 2.26% in January to 4.17% in February. The impact of WPI will get reflected in CPI with a lag effect. Given the higher borrowing with fiscal deficits target of 4.5% by 2025-26 and RBI on inflation projection of 5% till September, challenging for RBI to keep at 4%. So one is inflation, second is higher crude prices. As we know, the crude prices were $40 per barrel 6 months back. Now it is around $70 per barrel. So as per the report of Global Investment Banking from Goldman Sachs, it can cross $80 per barrel by end of this year. So this will also put inflation high. And the third challenge, you can say, second wave of COVID. And as we know that today is more than 80,000 cases, and even in Delhi, 3,700 cases of COVID. In spite of acceleration of vaccination and many good treatment by the hospitals, still cases are increasing. So though last year at this time around lockdown was there, but this time policy is not keeping the lockdown, but challenges is there because COVID cases are increasing. So disruption in supply chain and all other productions and all other will be happening, will little affect due to government having so many conditions to tackle all these, addressing all these problems. One more fourth point, you can say rising government scrutiny yields. Though it is a global phenomenon, government scrutiny yields is rising everywhere in the world, even US, UK, and everywhere. And it's the same way it has been increased from 5.94% to 6.21% in the last 2 months. So, and the government, central government and the state government has a borrowing plan is around 20 lakh crore. So, in 21-22, so to keep this rate, as I told you, that RBI should not increase the repo rate. So which will be a great challenge, because once this government scrutiny yield, which is a benchmark for the borrowings, and if it is increasing, then inflation and all other rates will definitely have burden. And this government scrutiny yields is also benchmark for private borrowings like bond and private borrowing. So it will also affect there also. And higher deposit rates, State Bank has increased 10 paisa, and all other banks are to raise deposits and to attract deposits. They have compelled to increase little bit deposit rates. The government is trying to reduce it, and once they have reduced, but they have taken it back. But still, I am thinking that all these are challenging times, and you can say the plus point is our GST collection record high of 23 3.75 lakh crore in March on the collection of February figure. So it's a good thing, and we are keeping our GST last 6 months more than 1 lakh crore, and it will still continue. So and in February we have seen our degrowth from April to 6 core sector degrowth by 8.2%, in February itself 4.6%, but we are expecting a better in March the core sector industries growth. So I think that can be compensated in March. So, but still economy is doing well, though I don't think RBI governor will increase the repo rate. They should keep the same, and accommodative stance should continue for the growth of the economy. And they are having a roadmap of fiscal target by 2025-26 government provided in the budget 4.5%. It should be maintained, and keeping in view, I think RBI will do the justice. So I conclude my remarks here. Thank you very much. Again, welcoming all of you to join this discussion, and thank you very much.
Thank you, Mr. Agarwal. So before I invite the panelists, I guess we have now 4 panelists. So I'll actually start with Abik, and then go to Mr. Rishi Agarwal, then come to Bank of America. Name is going out of my mind.
Indranil.
Huh? Indranil, sorry. And then Charan. Let me lay out, I think it's a good time to take stock because we've just finished the pandemic year, and given that we have one less panelist, I'll just take a little time to lay out, something we had outlined. As some of you are aware, at EGROW, we've done a series of papers. We've done 6 or 7 research and policy papers on the whole lockdown and the pandemic. And what I'll quickly do, because it's also relevant for the going forward and actually for inflation also, I'll take very quick stock of what we have been saying and how much it has panned out, because it has implications for the future. So at the start of the lockdown, we had said that this is a very peculiar situation where you're shutting down 60% of the economy and leaving aside 40%, which is the essential commodities. So essential commodities will remain more or less normal. Actually, they were a little less normal than one had anticipated, but we were basically right about the 3 sectors. And then we had said that there are 3 sub-aggregates. So one was the essential commodities, which were not locked down, basically food, medicines, and communications, telecommunications. And the second sector, which was most affected by pandemic and which we had said will remain affected for much longer, is what we call contact services. And if you think in GDP sectors, it is trade, transport, hotels, restaurants, and personal services, which the category called other services, which has things which will things like marriage parties, etc., would all come in that category. Hospitality, if you want to give it a common name. That was a sector which we had anticipated will take longer to normalize. And then the rest of the economy, which is basically, you think of manufacturing, mining, construction, I'll just call it that, but everything else, and related services. So the transport services related to that, some of the trade, I forgot to mention in contact services, trade is very important. It's trade, transport, hotels, restaurants, etc. So the inputs into manufacturing, etc., also go through trade and transport. We said that would recover faster. So everything else, contact meaning where you meet a lot of people. So those were the services we had anticipated, and we have correctly, that's exactly what it has played out. Now, then we moved to transition. We said in the transition from lockdown to to normalcy, there were one, of course, is the two-speed recovery, which I've just pointed to, that there would be a transition to normalcy in which, and again, it's very important to keep in mind, and I'll say a little bit about the international aspects, which I had not detailed earlier, is that we said there would be logistics disruptions in this transition, supply chain disruptions, and supply demand imbalances, which would vary with commodity and services and geographies. So that is exactly how it is playing out, that different goods and services had faced different things. And the interesting part, which is new, is exactly the same sort of thing is happening on the international side. I'll come back to that. So what does it mean when we say supply demand imbalances? What we had said at that point was that because it would be different commodities, you would see spurts of lack of demand in some areas and some commodities, and excessive demand in others, leading to inflation, so that the supply is not able to meet it for the reasons I've just outlined. And that's kind of what has happened. Now, what has emerged since then is a macro picture where there is a duality. So not only is there a two-speed recovery, but what is very interesting is we find both domestically and internationally, and I'll give you some examples, is that there is a temporary, it's kind of a new normalcy, that even though MMCS has become normalized, there is an opposite problem. There is an excess demand for this whole sector because they are unable or unwilling to subject themselves to the risk of COVID in these contact services where there are lots of other people. They are shifting that demand to goods and goods. Okay, it's a very interesting phenomena. You will see it in India. So let me tell you the implication of that. The implication is that has led to further spurts in prices of these, which will be reflected in the core inflation. That's the problem, which comes out in the inflation part of it. The interesting thing is this is exactly what is happening in the US, for example. How does it manifest itself? It turns out that the demand for imports of goods through Chicago port has gone up so sharply that logistic costs and time delays have gone up by 20% or more, and there's too much demand. So this is feeding into both the logistic costs. Ports are choked, okay, because there is so much demand. It's not that the whole economy is booming. This is before the stimulus package, by the way. So these very peculiar effects, the structural, but it's temporary in the sense of till there is complete vaccination, So that is one thing. Now, complete varies from different places. It'll have different time effects. US expects within 6 months. India may take 1.5 years. So again, it'll be variable. So a lot of uncertainty. So be prepared for uncertainty for the next year or so, both the monetary and fiscal authority. One more point on this before I come to the global. As far as the contact services are concerned, again, I have repeatedly in my budget presentations to the PM and FM, I'm also invited as economist to speak to the governor as this meeting of economists. For the last 3 meetings, which are held every 2 months before the MPC, I have been warning that both government and the monetary authorities must now give more attention to these contact services. What was done earlier was very good. The credit enhancement, the guarantees, etc. But most of those were focused on the MMC sector, as I called it, and not enough on these. So I have been urging them, please focus on this. And here, one of the important things which has not been done, unfortunately, it's either not understood or my message didn't go through to the Ministry of Finance, is that we need to incentivize these putting up of air filters. The key problem which we know now is in internal closed environment where there is little ventilation. So wherever there is air circulation or still air, you need to have filters which will take out the virus and therefore make everybody safe actually. And it's a big advertisement also, whether it's malls or cinemas or marriage halls or any of these places, if they were incentivized to put these filters, and then they could publicize it, okay? And you would get over this contact services problem much more quickly. Sadly, this has not happened despite my saying for the last 6 months. The message has not gone through, but I leave this message. In fact, I remember in my talk to some of ASSOCHAM and maybe other Punjab Haryana chamber, I said the same thing. But so it's not just the government, it's not just the state government. This message is not getting through to the people involved in it. Now, to some extent, the large hotel chains, have got this message. They've tried to change their standard operation procedures to make sure that people who come there don't get the virus, and therefore also used it as a way of reassuring people. So this is a message I want to give more generally. Now, the global part, okay? And I'll finish with that and then move on to the more detail. And of course, we'll come back to our suggestions at the end. We take the poll from the members. So what is the global? I've already told you what has happened in the US, this change on demand patterns, which you'll see all over the world actually, till we have this vaccination. So excess demand, so you should prepare. I think I'm already seeing a business, I had not seen this data, but the business data apparently shows a recovery in investment. If this is true, this is quicker than I had anticipated. I had not anticipated till the full year, which has just started, that business, MMCS business investment would recover very sharply. Okay, so, sorry, somebody mute, somebody's talking, please mute. I think Mr. Kamal, you have to shut off, you mute yourself. Anyway, everybody should be mute, otherwise there's an echo. Okay, so the recovery in this MMCS sector, I expect, will now gather pace in the new year, especially when we start seeing this 25% year-on-year growth rates, which one expects in the Q1 of next year. I think the investment will pick up much faster in these sectors. Okay, so that's one implication of it. Now, but the other implications are negative. As I've already mentioned, logistic costs have gone up, so exports are becoming a little more costly, though we are benefiting from this supply chain diversification. But the effect on commodity things, semiconductors, we have seen, this is that demonstration of these pockets of excess demand where the supply is not able to keep up. So we are seeing those disruptions. And then, of course, the effect on commodities, which is also, in my view, linked to these disruptions, say, from China. The way they manage their stocks and inventory build-up, drawdown, I think has affected this. I think this is not permanent till the economy fully recovers, but it's there. But hopefully, my analysis would suggest it's still short-term in the sense of months rather than years where we see them. Okay, so that's basically the broad outline. Oh, sorry. Finally, the US implication. I was hoping somebody else would take it up, but none of my private sector economists seem to be wanting to talk about it. So I'll just mention it. And here it is that they all know this better. Maybe somebody will touch on it. I'll just mention the point that US GDP is expected to go up, USD to strengthen, and real interest rates to rise in the US. Now, this will likely affect capital flows into India and also make our interest rate management a little more difficult. And here really the RBI has to manage it. I can't predict exactly how they'll manage it. Maybe some of our other panelists have a thought on this. But as far as we as observers are concerned, I think we'll just have to watch it, because this is going to affect how exactly the capital flows are managed, the money supply changes, and the effect on the Indian interest rates and their interest rate policy. I just want to leave it there and call on our first panelist, a member of the committee, Abhik.
Yeah, I'm just starting my video. Just give me a second. Yeah.
Sure. Take your time. Yeah.
Yeah. Am I visible now?
No.
Visible?
Yes, sir.
Okay. All right. Yeah. So I actually, Dr. Nirmani, in the message that I sent you, I did mention that I would talk a little bit about US yields, and I think that's, in a very, very uncertain world, a couple of things we are relatively more sanguine about, I think, is of course China, which has escaped the the intense wrath of the virus, and the US, which seems to be fueled by both fiscal and monetary policy, which are turbocharged, climbing back onto very high growth, a very high growth path. The latest forecast by the Federal Reserve Board, which is the equivalent of the RBI there, puts it at 6.5%. And this is, of course, leading to a lot of things. One of them are inflationary expectations, the apprehensions about excess supply of bonds to fund this, fiscal expansion. The fiscal expansion really is the first round of relief and stimulus that was related to the pandemic, and then now you have a prospect of a sort of a staggered infrastructure push, which could be as big as $4 trillion, which is leading to an increase in US yields. And I think this is likely to continue. And typically, as US yields rise, the so-called carry trade, which is, you borrow in US dollars and you invest in riskier assets, including Indian stocks and bonds, that the carry opportunity tends to diminish. So at this stage, we can perhaps say that the bias in the rupee would be more towards depreciation rather than appreciation as this money kind of pulls out. And I think the broad expectation is that the rise in US yields will continue and perhaps even cross the 2% mark. It's roughly about 1.75% now. I think Indranil is going to talk a little more about the RBI's intervention strategy and so forth. And I'm not going to sort of talk too much about this, except for the fact that the RBI has been intervening, appears to want to keep the rupee in a band. It doesn't want a runaway depreciation of the rupee, which a lot of economists often support, because you're making the rupee competitive and you are getting far cheaper or relatively cheaper vis-a-vis your competitors. The RBI clearly, for its own reasons, perhaps the risk of imported inflation, etc., wants to keep it in a band. So it's been intervening on both sides. So when it appreciates, it has been trying to break the appreciation, and when it depreciates, it's also trying to break the depreciation. And the limited point I'm trying to make is that I think the RBI's activities going forward are likely to be more contractionary, because they will have to depreciate, take rupees, fight depreciation, and take rupees out of the market rather than inject them in the market, which is what it does when it tries to prevent appreciation. Let me sort of move on to the second point that I want to make, is that I think we need to revise, or at least build in the scope for revision of our growth projections, etc. The second wave of the pandemic is not an abstract risk. It is there, and it seems to be far more vicious in terms of the rate of infection, etc., than the first wave. And if you see, people keep talking about the vaccine, people keep sort of parroting the phrase that lockdowns are not the solution. But if you just look at the examples of successful vaccination programs, which is that in the UK, it's been a combination of almost complete lockdown and vaccination. And people and countries that have just followed just the vaccination route, like Brazil, which is comparable to India because emerging market, they failed miserably. So I don't think, I think, this would be my appeal to the Monetary Policy Committee, that just saying that no, the economy will not be affected by the second wave of the infection, etc., and we'll sort of continue. There'll be minor problems, niggles here and there, is perhaps being a little too optimistic. This one is a big one. It's far more vicious. There are mutations involved, and the pace of vaccination is nowhere close to being able to offset this. So the interruption to economic activity for a reasonably prolonged period, which both in terms of demand as well as supply, has to be recognized in policy making. And I just hope the Monetary Policy Committee takes note of this and sort of expresses its views on how this should be handled. And I think one of the things that I would like to mention is that it's now, unlike the first wave, which was largely sort of an urban phenomenon, it was a city phenomenon. Now we're getting evidence that it has spread to the rural areas. And I think the spread to the rural areas would be even more going forward, because we've had all these election rallies where people from the villages have come, no social distancing, no masks, nothing. So we are possibly looking at a far more difficult animal that we need to tackle from policy perspective. And inflation, whether it's sort of the rise in core inflation is transient or not, is something that we can debate. I'm not going to go into it, but the fact is that core inflation is high, and it's not transient in the sense of a short-term supply shock like a vegetable price increase. It's been embedded in the system. So on balance, what do I think? I think the RBI. I don't think the RBI should focus on taming inflation, but its hands in terms of cutting the policy rates are tied. And I think I would sort of argue from the perspective of lenders to the banking system, the depositors. I think they would really get the wrong end of the stick if you brought rates down further. The other important development has been that we are more or less accepting yield management, and this is what Mr. Agarwal also said, that managing government bond yields is now being accepted as almost an explicit goal of monetary policy. I think this should continue through open market operations and so forth. Again, my limited suggestion is that right after the budget, when because of the high borrowings and the prospect of high growth, the 10-year bond yield started to move up. There was a tendency to sort of try and bring it down. There was an effort to bring it down to below 6%, which was the level at which it had sort of traded at during the pandemic period. I think choosing these arbitrary levels is kind of very distortionary, and this backfired, and the yield sort of started climbing back up. So while I think I agree with the strategy of yield management, and indeed other central banks are following it, I think yield should be managed along a dynamic path, which sort of reflects the underlying fundamentals, for the lack of a better word, the borrowing program, growth prospects, inflation, and so forth. So I think the RBI should certainly manage yields, but not get fixated on a particular level. I actually think that as Dr. Rakesh Mohan recently pointed out, that we should sort of actually work with a higher inflation target. Why fret over this 4% number? 5% is perhaps what we should be comfortable with. But fortunately, unlike previous regimes, I think the current governor uses discretion, and the band that he has been given, instead of chasing a 4% number willy-nilly, despite other conditions. And so I think inflation might be high, but I don't think that should be the principal driver of policy going forward. Just one more point, I think, that I'd like to make. The RBI is if you've been looking at, if you're borrowing, a lot of company people here who are borrowing, there's a lot of emphasis on long-term borrowing for infrastructure, etc. The RBI has kind of got fixated on this 10-year bond yield. And most of the open market operations, which is basically the RBI buying the 10-year bond and keeping the yields at a particular level, that has become too narrowly focused on the 10-year bond yield. The long-term yields have moved up far more sharply. So I think the open market operations should perhaps be a little more distributed across the spectrum, especially towards long bonds, so that when we as banks are pricing something for borrowers like you, we have a relatively competitive and low benchmark to go by, rather than very high long-term yields. And by long-term, I mean 15, 20, 25-year paper, these yields should also be taken into consideration when the RBI does its buy bonds and infuse rupees kind of operation to keep yields down. I will end here.
Thank you. Let me just clarify one thing and ask you for a clarification.
Yes.
Firstly, I want to be sure that it's understood that what I was saying is that the change in the structure of demand from services to commodities has had both domestic and international effects which have raised the core inflation. I'm not
Yes.
saying that it's so how long it lasts, I'm not sure. But what I want a clarification from you, you didn't say anything about your projections of core or other inflation. And if you have them, you might want to just put it to
Certainly, our
listeners.
forecast for I'm just going to put my aggregate inflation numbers because that's what I remember offhand. 5.4% for the first half and 5.6% for the second half, and this is premised on a 5% core inflation number, which has been there. It was excessively high for the last month, 5.6. That will perhaps moderate base effect and so forth. But it's again, core inflation is not just one category which is pushing things up. It's a combination of services like health, personal care and effects, which are goods, recreation, etc. And some of these numbers are alarmingly high. I mean, you're looking at 8%, 8.5% kind of numbers. I don't expect this to dissipate at least till the end of this calendar year. And then let's see what happens. I think in this period of uncertainty, it's good to be more short term in one's assessment and projections. Yeah.
Okay. Very good point. Again, I want to relate it because, as I said, I think the final conclusion of what RBI is going to do and what we will recommend is probably more or less same for everybody. So, but what I said about, remember, contact services, there were two parts. The second part was other services and personal services. So the interesting, and that's why there's so much uncertainty, is that this supply demand balance in each service is taking a different course, and it's not a priority predictable. So think of some personal services. You both have, people have withdrawn, the suppliers, because there was no demand. Now, why are they not coming back? Because their general demand is still low, because many people or their regular customers are not going back. But then there are customers who want this thing and they are looking for new suppliers. Okay. So you are again getting these, just to give one example, my barber started coming to houses, so I can call him. But, there'll be many other people, so my point is here, not the specific example, but these disruptions are taking many different forms, different from what we have conventionally thought. That's the point I want to make when you say that certain services have suddenly prices are shooting up. What I'm trying to say is that geographically and country-wise, there are these individualistic disruptions which are causing all kinds of funny things to happen. That's all the message I want to leave everybody with. Okay, now I think if I remember, Mr. Rishi Gupta, I found your thing interesting, but I don't remember it. Do you want to just introduce yourself? Of course, you're chairman of the subcommittee, but your day job, FinOpay.
I'll do that. I'm more of a practitioner than an economist, so my views will be more from a business point of view. And before I start, a very good afternoon to everybody, to the chairman, Dr. Virmani, and other panelists. I'll start with, sir, your own example in which you were talking about that services are getting impacted, and I would completely agree with it. Because what we are doing in Fino Payments Bank is a very different kind of services. We are trying to make local merchants as trust points, as banking points. And we have seen that during COVID, from the first week till now, our volumes have nearly doubled in the last 1 year, because people don't want to travel far off. People don't want to go to crowded branches. People don't want to go to crowded ATMs. They rather go to a local merchant to withdraw or to deposit money and do the banking services. So you're absolutely right that a differentiation is happening. A different kind of services have started to emerge. And I think that's the real change. And we are also seeing that this change in the consumer behavior to go more local and to go more digital. It seems like a more of a permanent behavior change and more of a habit change right now. And even during the strikes which we see in the banking ecosystem, or the last 2 days when the banks were closed, we could see the volumes really jumping for us because the customers feel this is a better trusted point than to travel all the way. So I completely echo your point in terms of the contact services, that there is kind of a disruption there, and contactless services, doorstop services are becoming the order of the day. Coming to right now, I would start my talk in terms of going through the challenges which are there in the economy. Part of it has got covered by Mr. Agarwal and Abhik as well. But from my side, I think the COVID cases are surging, and it's going to be imminent fear. And what we are seeing it is more the urban phenomena. Within the urban phenomena also, it is the high-rise phenomena, especially in Mumbai. My own society has about 25 odd cases. In the peak of COVID, we didn't have that many cases. My building has been sealed for the last 10 days, and every few days there are some more cases, even after sealing, are emerging. So this is going to be there. This is an imminent fear. So I could see the number of people going for vaccination is going up, and I kind of agree to what Abhik is saying in terms of just vaccination probably may not have the right answer. Some kind of a shutdown, local shutdown also, but I'm being a business community guy. I'm worried about the lockdowns and the impact of lockdowns, which it can have on, and the permanent damage it can do in the long run. The inflation is going high, but I think at 5% plus, I think we can all live with that number rather than worry too much about it. With inflation, I think the growth numbers also comes up. The government inflation target also at 4% plus minus 2% is a good target. And that is what Abhik is also saying, that probably the government is also managing within the band rather than just looking at 4% as the core number as such. Despite that, sir, we are seeing there is, being in a payments business, we understand, and we are seeing actually a big shift which is happening on the digital ecosystem. There's a big offline to online demand. There's a big demand for local becoming more and more prominent. There is still a very strong circulation of currency which is going on in the country. The industrial activities have surged, though there has been some dip in the last 1 or 2 months, but largely the industrial activities are surged. And fortunately, during this lockdown also, the manufacturing sectors are spared. So even manufacturings are not getting impacted to that extent. There is some supply supply chain issues which will come up because of the local lockdowns, and that is something I think the government has to worry and work on. My own recommendations and my own thought is that to give the necessary boost to the business, the monetary policy need to continue with the accommodative stance, and we need to maintain the status quo on rates, even when there is surplus liquidity in the system as such, because the growth is the only savior in the long term. We have to do this through a combination of a fiscal and a monetary policy combination. We saw that the government started to reduce the yields on government saving schemes, but then they retracted a few days back. So while the gap between the bank yields and the government saving scheme yields have widened quite a bit, but I think the bank rates that will continue for some time. We saw that some of the public sector banks, even some of the private sector banks, have raised deposit rates. So some kind of hardening is there, and that gap may kind of go down in the months and years to come. What is very promising and good and very refreshing too was the recent budget, where the government has built up a very big infra pool, and they have said that the government will spend a lot of money in terms of on the infrastructure sector, which I will say will boost the job markets. We have seen the actual benefit of NREGA coming on the ground, especially during the COVID, and how it actually helped. The infra boom will definitely help the growth of the job and the employment in the country. It will also start, I think the working capital cycle, borrowing cycle will also start because of that. One more thing which is there, and I think Abhik also kind of alluded to it, was the private investments, the private equity investments, and we have seen there's a record private equity investments come up in the new sunrise industries, in the new service and the sectors. I would say the private capex investments need to further shore up. And the banks today have much more stronger balance sheet, high liquidity levels, low price of loans, and they are ready to sanction loans for good quality projects. So I think that is something which we need to push and maybe make it a part of government MPC, the RBI MPC, in terms of how they can push the banks to start doing more corporate loans and project loans, because that will really start the cycle of investments into the private sector. We all know the government has high liquidity in terms of forex exchange, sitting on a $580 billion of forex is a very good thing. So the rupee dollar rates, definitely there is a concern on account of that, but luckily for us, being the third largest country in the world with $580 billion of foreign exchange, should kind of smoothen that kind of an impact in the short term to medium term. One more thing, sir, which I would say is that part of the IWG guidelines, internal working group guidelines, which government, the RBI came out in the month of December, and the submissions happened on January 15th. We are expecting that the government might form the final opinion on the IWG, which is talking about the new universal banks and small finance banks. And that may see something in the MPC, because the government has recently formed a standing external advisory committee headed by Mrs. Shamla Gopinath. And we would see some light of the day on those guidelines, which will mean that private sector participation in banking ecosystem will further grow, and which is good for the ecosystem as such. So that is all from my side, sir, as part of my remarks on the MPC. Thank you.
Thank you. Our next speaker is Indranil Sengupta, who is the Chief Economist at the Bank of America. Indranil.
You are muted, Indranil.
Yeah. Thank you, sir. I think the short point I'd make is that we continue to expect the RBI to be on hold this fiscal and hike 100 basis points in FY23. Looking at growth, our base case is a rebound of 9% in FY22 from a 6.4% decline this year. But clearly, if COVID cases rise, we could see a 300 basis point risk to that. The vaccination program clearly is lagging, and we don't expect more than 1/3 of the population to be vaccinated by December. On inflation, I will say that we are actually expecting inflation to come down, settle around 4.5% levels in the first half of the year. Largely driven by the fact that there are strong base effects, imported inflation remains low, demand remains low, and while money supply growth can be a worry, it typically takes about 12 months to spill over. Core inflation, again, by our metric, is about 4.5%. I think that the reason why core inflation appears high is that the RBI takes off fuel, which does not have petrol and diesel. So you have, I have never understood statements like, core X fuel went up because the price of diesel and petrol went up. So if you cut off, actually take out petrol and diesel and gold and silver, then you're somewhere around 4.5%. Now, of course, I was actually expecting the RBI to come out with its new or the MOF to come out with its new inflation mandate by Friday, but that doesn't seem to have happened. But I am guessing that the 2 to 6% band will remain in some manner or form. Is it 4% plus minus 2, or is it 2 to 6? That we'll probably come to know on Monday. But I think the operative level for tightening will now climb to 5.5 to 6%, because that is the threshold inflation which the report on currency and finance has identified. Of course, it is another matter that the previous report on currency and finance had identified threshold CPI inflation between 6.2 to 6.7, and I never understood what logic took the inflation target to 4. But I am assuming that as I think Avik said, that the governor will use his discretion in the current circumstances, and therefore we'll probably have the RBI will probably tighten only if inflation sustainably hits 6%. So coming to the main challenge of monetary policy, I think is to now fund the fiscal deficit, because the fiscal deficit by itself is high. There are upside risks clearly, because number one, it remains to be seen whether the PSU divestment program can go through. LIC clearly has all the set of problems it had last year are persisting this year. And then you have oil taxes, which may need to be cut, because you cannot go on piling on oil taxes like this either. So we think that the challenge is for the RBI will be that there is an excess supply of anything between 6 to 7 lakh crore that will come in the market. You cannot really monetize as freely as earlier, because you already have high money supply growth, you already have high liquidity in the money market. And secondly, you have to take care of the MTM hit, because when banks have G-Secs 10% above SLR, why will they take a hit on MTM? So therefore, we think that number one, the RBI will have to OMO maybe anything between $45 to $50 billion, and back that up with long-term reverse repos. So the RBI owns the government paper, but it is held by the banks, and the MTM risk shifts to the RBI. Secondly, again, you raise HTM, which again means the same thing, that you are reducing the MTM hit on bank balance sheets maybe by 3.5%. And thirdly, we think that they'll have to continue with forward purchases, FX purchases. Now, obviously, the last year the RBI bought $125 billion, both spot and forward. This year we are looking at 34 billion, all in all. Now, and this is predicated on oil of 63 to the barrel, which is our house view, and a current account deficit of 0.9%. Of course, as oil prices are higher, then there is greater scope of OMO and lesser FX intervention. So all in all, I think that the big challenge for the RBI will be to put through the fiscal borrowing program. Like I said, that there are risks from PSU divestment shortfall. There are risks from oil taxes having to be cut, and let us also see whether we get through this second wave of COVID without a lockdown, because the pace of rise is clearly much faster than what we saw in 2020. So net, looking at RBI on hold this year and 100 basis point hike next year.
Okay, thank you. Let's turn to the Dr. Charan Singh. Can't see you. Where have you gone?
Actually, I was requesting that there is one addition name which has been done, and if you can please permit Mr. Mishra to speak before me.
Okay, can you introduce him?
From ASSOCHAM.
Okay, yeah, I hope brief comments. Yeah, sure. Go ahead, Mr. Mishra.
Yeah, a very good evening to one and all present in this virtual meeting. First of all, I would like to thank ASSOCHAM and EGROW for giving me an opportunity to be part of this meeting. As we all are aware, these are challenging times in view of the pandemic that is happening right now. But again, we think that there lies a great opportunity for India, even during these challenging times. as we see, there has been a lot of adoption of digital technology, not only to sort of do our day-to-day activities, but also to gain competitive advantage. And that is what is the change that we are facing in our business activities nowadays. Coming back to the topic on hand, that is monetary policy, we all are aware that the RBI in India is the authority in charge of monetary policy implementation, and we demanded the government, that is the central government of India, is setting the inflation target. Currently, as we all are aware, it is set at 4% with the upside of 6% and a downside of 2%. But we think that it is the responsibility of RBI to attain these objectives with the monetary policy instruments, and they have done quite a good job with respect to the past data. But again, we cannot see things in silos, because when we also see that the finance ministry and the government of India has done a commendable job through fiscal policy initiatives in focusing the growth initiative that is the target for the country. So as a member of the industry, I think that the groundwork has been done for us to attain the growth objectives for our industry and also the growth objective for the country as a whole. Having said that, I am of the opinion that the industry on themselves can have the demand side controlling. What I mean by that is through improving the quality of our product and services and also bringing in more and more innovation, we can increase the demand for our goods and services in not only in Indian market or Indian market perspective, but also we can gain increasing share in the global market. So that is the viewpoint as an industry member. And there are some. Yeah, so as a member of the industry, like I represent a startup called Acceptance Re-Innovation Technology, and we are working on inventing and innovating smart energy meters and related technologies. And we are focused on building a portfolio of IPs, intellectual properties, to better serve our industry. So that is our focus area, and that is what our viewpoint is. But I'm sure other panelists are better, are economists, and they have a better.
Thank you, Mr. Mishra. Charan Singh? Charan?
So I must thank him for organizing this event. Much has already been said, and therefore I'm not going to go over it, but I have a few additional points which I would like to mention. And therefore I'm going to argue that there is something concerning, and therefore inflation target for this year, for the coming year, needs to be paused. So let me present my thoughts first. The latest data that we have of IIP, and that is again not very encouraging. What is happening is electricity is better than February 20, but mining and manufacturing yet not even the January 20 level. If we look at the 8 core industries, in 7 core industries, the levels, and this is February data, the levels are below that of February 20. Only electricity is better than February 20. Yes, the WPI has been around 4.1, all commodities. Food is 3.3, and the latest data that we have on CPI is 5.03, which is causing concern to everybody. But then I would agree with both Abhi and Indranil, who have said that they are looking at inflation around 4.5 to 5%. When we look at output growth, again, some uncertainty has set in. The IMF in January had predicted 11.5 for 2021, 6.8 for 2022 calendar year. The World Bank has just come out with an estimate of 21-22 at 10.1%. The IMF is going to come out with an estimate for India on April 5, Monday, 2 days from now. So we'll see what is the latest estimate that is coming from there. I want to speak a little bit about the banking sector and the non-banking finance companies. As far as the banking is concerned, too much is expected during the current year. Privatization, disinvestment, consolidation of banks is what has come in the budget also. The bank is going to be set up. So that is a real good thing. The DFI, Development Finance Institution, is going to be set up, and that's going to take over the infrastructure. To that extent, infrastructure will get a boost. The balance sheet of the commercial banks will get a little cleaner. Now, the estimates in the Financial Stability Report of the Reserve Bank of India, which was done in December 20 and released in January 21, says that the gross NPAs would increase from 7.5% in September 2020 to 13.5% in September 2021. And if there is high stress, this figure in September 2021 could rise to 14.8%. So already high stress in September 2020, and from there it doubles up to 14.8% in 2021. Yes, at this point of time, there are funds in the banking industry and they're waiting for good projects to offtake. Many of them are giving good concessions, if you want to call that, or low rates of interest for really extending the credit. But the times are difficult. And as has been mentioned, the gross fiscal deficit is high. The government borrowing requirements are going to be high. The yield management by the RBI, of course, is going to be difficult and challenging, but the yield rate there is expected to be high. Now, what I'm trying to say is that if you go by the experience of the 1918 Spanish pandemic, the second phase was 5 times lethal than the first phase, and the third phase was 2 times lethal than the first phase. We have already seen what has happened in the last 1 month. The rate is rising very rapidly. We have heard instances in the last 45 odd minutes. Also, the country has been in the election mode, and the states in which elections have taken place, and I've been speaking to some of them privately, the fear is that after the elections are over, the data is going to be very fearsome and probably lockdown will have to be imposed. The lockdown may have to be imposed in some way. Curfews and night curfews have already started extending, and if the figures exceed the direction in which they are going, they exceed 90,000 odd, then obviously the lockdown will become almost essential. In that case, the growth is going to be impacted tremendously. I'm now starting to think, and Mr. Chairman, you should, in your closing remarks, guide us. I'm now starting to think, will we have the K-shaped recovery? And in your presentation, also you mentioned that you saw different segments growing at different paces and in different directions. So now that we are in such an uncertain phase again, where we were in the month of May 2020, I think we need to rethink at our inflation target. My recommendation would be we give a pause to inflation target for at least 1 year, so that the second phase, which is expected to be more lethal, the election phase which has happened, and post-election, some things are expected to be very dire. The lockdowns could happen. Even if the lockdowns don't happen, the fear and the mortality rate is rising, so that can have an impact on both investment and growth. Therefore, the RBI's focus now should be growth and sole growth, and inflation should take the backseat. As it is, if the inflationary expectations are anchored around 5 to 6%, and we just heard the industry saying 5% or that doesn't really matter, it's the employment and growth that matters, I think therefore inflation target needs to take the backseat. The last point I want to make is, in the situation that we are, and going by the global scenario, both the US and Bank of England, 4% is our repo rate. I think there is scope for further reduction. And I think just to tell the industry and the business that here we are to spark growth. Now, this also goes to the lecture we had from Dr. S.S. Bhalla yesterday under EGROW, where he categorically showed and clearly articulated that the repo rate does not really have much impact on inflation. If that be the case, my request is, and his conclusions, Dr. Bhalla's conclusions, that, and after an extensive global and India-based study, that repo rate does have an impact on investment and growth. So my recommendation would be, situation is grim. The first policy announcement for the forthcoming year. Of course, every 2 years they keep adjusting, but the message has to be loud and clear, and that will come in case there is a 25 basis point reduction in the repo rate. Thank you, Mr. Chairman.
Thank you. I think everybody have you noted, because you have to note the views of on the repo, etc. I guess 3 of you have given. You got that, or should I ask them to do it again?
Yeah, accommodative policy, almost everybody has said. Indranil said they would like to continue with the same.
Yeah.
Rishi also said the same. Abhik also
Right.
said the same.
Yeah, so I will speak. I will come to my recommendation right now after a few points you raised. So yeah, I think the way I would put the discussion so far seems to be, at least among the regular panelists, and that there are 2 optimists and 2 pessimists. I think the outside speaker, the ASSOCHAM speakers were kind of 1-1 in a way. No, I think both seemed a little optimistic. But anyway, our regular monetary panelist, I guess I and Indranil are on the optimistic side, either in terms of GDP or inflation or both. And the 2 of you were a bit on that side. But let me, I think there have already been an indication from the government. I remember reading something, maybe it was not official, but semi-official, that the target will remain at 2 to 6%. This is what I remember from a couple of days ago, but maybe they've not made a formal announcement. And the key point here is, I would say that the RBI under the current governor has taken the flexible in FIT, in flexible inflation targeting more seriously, and will continue to do that. I think given this adjustment of 2 to 6% and more recognition of the GDP and GDP growth aspects in the flexible, because flexible is such a loose word, it could be interpreted in any way. For a long time, I would say under the Raghuram Rajan and Urjit Patel, it was very rigorously interpreted, or hard interpretation, that we don't care if we over predict inflation and therefore tighten the monetary policy more than necessary or more than we are saying. We don't care about its effect on GDP. I think that kind of flexibility has been replaced by saying, okay, we have to be very, very careful, particularly in a pandemic, and also coming out of the pandemic, that flexible must be taken very seriously. And therefore, unless we are sure about our inflation projections, we are not going to over predict, and tighten more than is necessary. And for the time being, it's better to err on the other side. This is how I would describe the actions and the RBI under the new government. Okay. Now, having said that, I also acknowledge the point you made, which in fact I had discussed earlier on Rajya Sabha TV, but a very important point which we had missed is that there's a clear, there are 2 things which are coming out. One which is very optimistic, that is the tax collections. The one which is pessimistic is this very strange numbers on IIP. And let me, before I give my monetary predictions and go to question and answer, let me complete that. So, which is a positive. It's very interesting. Again, I would say much better than I predicted, the tax collections. So GST total is coming slightly positive for the whole year. The whole pandemic year is showing positive growth. The personal income tax is showing positive growth. CIT, the corporate income tax, is showing marginally negative, so that overall collections, these are not affected by your excise. This is GST, personal income tax, corporate tax taken together seems to be mildly positive. This is in a year when the official GDP forecast is -8%. So that seems to be, to me, a very positive sign. The part which is very hard to explain and which is negative is exactly what you said, the IIP core, which is puzzling. Steel, coal, cement. Now, while you were mentioning it, it seems to me that maybe the construction part of the MMC, where we were anticipating a good recovery and normalization, seemed to have flagged. Some of the points have been mentioned by our earlier panelists. One is that the delay in the acceleration of public investment. So private investment was clearly down, that we all knew. We were all hoping that public investment will pick up quickly to replace that. Maybe that's not happened. So the little adjustment in housing and other things where there was a little private pickup maybe has collapsed, okay, or it was temporary. And therefore, we should expect that to change. But it's clear the data is kind of disturbing, and I'm not saying I know the answer. I'm just trying to give a possible answer. And therefore, we would expect that hopefully as the government investment program picks up and the construction picks up, that thing will be overcome. But I don't know for sure. So what is it? So the uncertainty is clearly very high. We have a whole range of opinions. We have these contradictory data coming in. So my own suggestion, just to complete the regular members' projection, is that hold on interest rate and liquidity. No big changes, even in liquidity. A number of people are saying liquidity is too high. I think the uncertainty is too high to do any sharp reduction in that. Be careful. No argument for even raising it more either. I'm not saying raise it. So kind of a hold on both rates, repo rates and liquidity, and guidance to remain accommodative. So you can note that, and let's have some questions, then we can come back to other issues which are left out. So the floor is open for questions. Have you seen any? Do you want to call on somebody you've noticed?
Mr. Chairman, I would like Mr. Narendra to present his views.
Yes, Mr. Narendra.
Yeah. Thank you, Charan Singh and Virmaniji. That I endorse the points raised by Charan Singh, and also I partly also or fully endorse the views of Indrani Sengupta. That the whole last year, I think Reserve Bank of India managed the government borrowing in such a way that their average cost would not have gone by above 5.90, and the 10-year yield and other, that was the focus, and they also gave the focus to the growth. So the inflation is within the overall flexible, as chairman has also mentioned. I think there is a chance that as you go forward, not necessarily now, if further boost to the growth, and the RBI's view that inflation is under control within that overall flexible, there may be a possibility of some more reduction in the repo rate, maybe up to 25 basis points. That is the one point which I want to have the view of the panelists. And second, as rightly pointed out, the liquidity which are there were the market really saw that these liquidity measures may be reversed. And the RBI also went ahead with the CRR, getting into the normal mode, and by May, I think it will be back to 4%. Now, that has really made the 10-year yield to go up, and the government has to borrow 7.25 lakh crores, I think, in the first half year. That is the central government, apart from state government. So I feel that Reserve Bank will further ensure enough liquidity and also manage the forex, that parity rate, and ensure that some of the idea of early reversal may not happen. So that is another view. So on these 2 points, I thought that the panelists can dwell on that, because currently in the second wave of COVID, there is a need that the RBI also has to respond. Even though currently maybe because it is too early of the financial year, the status quo and accommodative policy may be there. But as we go forward, if other than any other threat of major inflation, I don't think, because the monsoon also will be good, and only the commodity price, what chairman said, the steel, cement and other metal and copper, all that price have gone up. This may be a global thing. So if they are moderated, RBI will do some more boost to liquidity as well as rate reduction. and also ensure that the market to market what you call loss for the bank will not be there, and they will continue to subscribe to the government and central government securities. These are my views, sir.
Thank you, Mr. Narendra. I don't. While we are waiting for another question, unless Charan Singh has seen, let me just I forgot to comment on one issue. I was happy to have our a panelist from ASSOCHAM, because this is the point I missed. So I just want to re-emphasize that I agree with that. You know, the innovation. In fact, I've written it in 2 publications, one in FICCI and another place in a book which has come out. That really this. But I want to emphasize, because both our panelists quite rightly talked about the digitalization of the economy and the innovation which has taken place and is taking place. And and I want to put, and I agree with the points made, but what I want to put it is in my framework. This comes under the part which was not locked down, but is new. So we had basically food, health, and telecom. So what I'm very happy that the startups, the youngsters, I hear them now on business TV, so many younger people, entrepreneurs, startups who took advantage of the communication system which was open to think about new things. Of course, there was the delivery thing, which was kind of an extension still, but new deliveries, e-education, health services, all kinds of new things which have happened is very commendable, and one must take note of it, and that really is developing in sense new products which are Charan, by the way, not captured in the IIP. I mean, some of these things did not. Remember, the IIP is 2011-12 base. Okay, forget even development of old industries which were already changing, but there is 9 years of innovation, and that has picked up pace maybe in the last 2-3 years. The innovation system, which everybody is saying now that we could rightly be the 3rd or 4th largest ecosystem in the world. So clearly these are conventional IIP measures and all are not capturing it. And I hope, in fact, we should take that up, revision of IIP and other indices. We need to do that, CPI, IIP, and include some of these new ones. Of course, one should caution for the aggregate implication. The base is very small. So we must keep in mind that this will not have a huge impact on the actual economy now, but certainly we need to take account of it for its potential and growth. Okay, I see I see one more question from Mr. Mitral, Keval Krishan Mitral. Do you want to ask your question? हाँ, Keval Krishan ji. बोलिए, सुना, can't hear you. You are muted. Unmute कीजिए. हाँ, okay. Can't hear.
There's also a question waiting from Dr. Swami, Professor Swami from Hyderabad.
Okay, I don't see. अच्छा, ऊपर रह गए. Okay, sorry. No, I don't see the Swami one, so maybe we can just go. Oh, there it is. Okay. Yeah, that's just come to me. Okay. Mr. Mishra, we can't hear you. I don't, Mitral. I don't know what's happening. क्या करें?
We can go to Mr. Swami.
Yeah, ASSOCHAM will have to do something.
Yeah, now
okay,
I unmute.
Okay, go ahead. Go ahead.
This is Mittal from Delhi. When Dr. Indranil and Abhi, see, when 80,000 crore extra borrowing was announced by RBI last year in the year ended, so that time 10-year was near to 6% and 585 6%. Now this year, with all the efforts of RBI and good work by Governor, now it closed at 6.18 on 31st March. And ICRA, Nomura, Bank of America, I understand they have predicted one will be ending around 6.35, financial year 21. Now, what is the opinion of my learned friends who are here?
Okay, we will take this question together. Let me also allow Mr. Vigneshwar Swami, you want to ask your question? Then we'll take both questions together. Please, I hope Indraneel or somebody will be able to answer both of them. That one at least, yeah.
Thank you, Chairman,
Mr.
sir, for the opportunity. Am I audible?
Yeah.
Okay, sir. Let me be very specific in the interest of time. My question to the Shadow Monetary Policy Committee is, should the reverse repo rate under the LAF should remain unchanged at around 3.5% or should be raised by 25 to 40 basis points, keeping in view the rise in the inflation. And also, I feel that let the repo rate be at the same status quo level. So keeping this, what is the view of the Shadow Monetary Policy Committee?
Indraneel, please take that first, then if somebody wants to add.
So we are looking for status quo because, clearly the economy is weak. There is this risk of a second COVID shock. So we are looking at a status quo. That is number one. Secondly, recall that lending rates are now linked to the repo rate. So if you were to control or try to bring down lending rates, you'd actually have to cut repo rates rather than hike reverse repo rates at this point in time. I think once the economy normalizes, I think the RBI will also hike quite rapidly. I think the whole world will try to hike rapidly and, get back to more normal term policy rates, but maybe that time is not right now.
Thank you, Indraneel. Charan, do you want to add something to that?
My own feeling is, and I've been arguing about the reverse repo rate earlier, saying that they need to, because it's too lucrative. And therefore, the banks find it very easy to go and park it at the reverse repo rate. And I have been actually arguing that the repo rate should not be so, reverse repo rate should not be so lucrative. It should be less so that the banks are forced, because banks will always tell you that at the end of the day, they can always go and park with the RBI at 3.35%. And I find it very offensive because they should be in the market lending, and that's how credit offtake should take place. But then the banks will come and say there are no good offers available that they want to put their money in. And that is where I think the risk taking starts, and that's where the legwork starts at the bank's level. So I would rather say a reduction in reverse repo rate is something which I appreciate, so that the banks are forced to go and lend rather than park it in the Reserve Bank.
Okay, I am going to, unless there's one more last question, if there is, otherwise I'm going to conclude it. Charan, do you see any other question?
I don't see a question, but because the debate has been so interesting, I was wondering if Mr. Tanksale would like to contribute or make an observation. He is in the audience.
Thank you, Charan, for observing that I am very much there. And my compliments to all the participants. I am happy Narendra is there, Rishi is there. So two bankers are already there representing the industry. The only thing which I would like to observe on your observation, that the bankers park the money under reverse repo because the rates are lucrative, is something probably as a banker I may not really totally agree. I mean, I've been very candid about it because that has never been the intention. But yes, for doing your treasury management, if you have a surplus, I mean, having said that, I'll say that how exactly more and more opportunities could be created for better investment by the bankers, because I think no banker will get away from a basic dharma of lending. And if I can earn much more in lending, why would I on the earth I will go for the parking of funds? I think those kind of a banking is a history now. Today it could be only waiting for the good opportunities to come. But having said that, I think I'm totally in concurrence with the various observations made by the panel speaker, and let us await what comes through the monetary policy. So thank you, Charan, and thanks to all the panelists.
So, yeah.
Charan Singh, 1 minute, sir. Charan Singh ji,
Okay.
that this reverse repo rate and repo rate that earlier it was between around 25. During the last COVID time, the Reserve Bank increased that to 65. In a sense, as your own point, that the bank should be discouraged for putting the money in the RBI, and that's why the lowest rate they kept at the 3.35. Now, if it is reversed and brought down that corridor to 25 basis point, then that may give a little bad opinion to the market in a way. So as Indrani has said, at the current it may be maintained, but as you go forward, there is a talk that this corridor can be corrected to the original level. Thank you, sir.
Find the corridor was 150 basis point also.
Charan Singh ji, I would just like to add one more point that you may be aware that in good times, RBI was paying even on the CRR. And there is every likelihood that 3 will become 4, has to become 4. I mean, on that I have absolutely no. But then again, it is a non-interest bearing 4% going. And when it comes to the translation, at times very sweeping remarks are made. Since you are chairing a bank, you would probably find it's extremely difficult when the translation is seen on a one-on-one basis, which is very, very difficult. But having said that, yes, probably we can say that the situation should look better and better going forward as the vaccination rates are increasing. The only thing I wish that nobody takes COVID for granted. That's all. Thank you.
Point I would like to make, Mr. Chairman, I participate in the discussions in the capacity of an economist, and I restrict my thoughts and my perceptions from an economist angle, please.
Thank you, sir.
Charan Singh ji, I saw one article, sir, Chairman ji, today that article that author is saying nowhere that CRR is there, and even in India, even though it was for a difficult period, the Reserve Bank never used the CRR route. So why not take away the CRR as such? One is that, of course, bank don't get interest, and another unnecessary you held up that 4% of the money. It may be 6 to 7 lakh crore. Why not during this type of distress take away the CRR and give a boost to the market? What is the opinion of the panelists, sir? This was the article today I saw.
Well, I think anyway, Indranil, you want to give your opinion? But I'm going to now stop the questions from the audience. But Indranil, you want to respond to that?
Yeah.
Muted, sir. You are muted. Unmute, sir.
हो गया unmute, हाँ. अब, yeah,
start again. Say that the long-term goal should be to reduce CRR, but right now you're raising CRR to do more OMO without adding to liquidity. So from that perspective, I think it's a good strategic move.
Yeah, so it's more like a monetary policy tool in a very special pandemic situation. Acha, Indranil, actually, let me ask you, because we haven't had this discussion. Really, is your difficulty with the the issue of financing, because presumably the focus was on that the RBI was not allowing for a while the interest rate to rise above 6 for whatever reason, right or wrong. So is your difficulty, I mean, presumably if that rate is allowed to rise, there will be a supply, right? Because you talked about the difficulty of financing the fiscal deficit, right? So, I mean, you're making certain assumptions that the interest rate on XYZ bonds will not allowed to be rise, or are you saying there is no balancing rate, or what exactly from a technical economist perspective? What is it that you're saying?
So, the problem comes when the rate is rising.
Mm-hmm.
If you are going from 6 to 7,
mm-hmm.
then for every bond you have bought at 6%, mm-hmm. you will have to book 7% MTM hit.
Right.
7. So if you are a sensible buyer, you will wait for it to go to 7.
Yeah.
And then buy.
Yeah. So what you're saying is, okay, I get it. That's a very important point. It's about expectations. So given that we are in a highly uncertain situation and an unusual situation, the expectations are not very well. I mean, I don't want to use the word anchored because I'm not talking about repo, but generally there is so much uncertainty. You're absolutely right. That's a very good point. That if somebody thinks that the ultimate rate will be 6.5, he will just not buy because it's too risky for that particular person. And if somebody thinks it's actually going to go to 7, again, they won't buy even at 6.5. A very important point. But the way I would interpret it in my framework is that there is huge uncertainty, because we are emerging out of going from still not fully from transition to normal. We are still in this kind of new normal, which has still a lot of uncertainties in many sectors and many aspects. And that itself creates some problems. I think that's a very important point, which Charan, I hope, well, we don't get the recording, but we need to put that down, somewhere. I don't know if any of your people are taking notes, or maybe AssoChem can send us the recording quickly so we don't miss. I think that's a very important issue, which generally, because there's an element of practicality and economics in it, which we should emphasize. Yeah.
There is there is a balance sheet implication, and we'll capture it in the important points in the discussion,
right,
sending it to us. We'll do.
Right. Okay. Well, thank you, everybody. I think that's been a good discussion. I'm sorry to kind of cut it off because I've been watching some discussions on TV, and basically they are not expecting much change. So I want to keep these discussions crisp and to the point, so we can have many such discussions and many people participating. So I didn't want it to extend too much, so I apologize if people have not been able to fully this thing, but I had thought 1.5 hours is good. When you have a continuing thing, every 2 months we have it to keep the interest alive. Okay. So thank you, everybody. And thank you for participating. Charan.
On behalf of the AssoCham, as the chairman of the banking vertical of AssoCham, I want to thank Dr. Virmani and the panelist, the core panelist, Mr. Indranil. Then Abhik was unwell, despite that he has come. And the new panelist that we have had today, Mr. Rishi. And I also want to thank Shri Agrawalji, who always gives us a very interesting introduction. And I wait to hear the industry's perspective from him. And then today, for the first time, we had also Mr. Mishra, and I think he also brought in value to our discussion. I want to thank the participants. I want to thank the participants who were able to articulate their questions and contribute to the discussion, and the other participants who were not actively articulating but participating in their own way. Look forward to, after 2 months, another such rich discussion. And just to mention, EGROW Foundation is having a very important discussion on April 9 on geopolitical implications of what is happening in Myanmar. You're welcome to join that 5:30 p.m. in the evening. With this, let me thank one and all for today's participation. Thank you.